What's going on, everybody? Cody here. So in this video, I'm going to be talking about the bond yield curve, the stock market, and gold, and how they relate from the past and how we can use that to maybe predict the future. So what you're looking at right here is the bond yield curve to your left, represented in this red line, and on the right, it's the S&P 500, the stock market. So right now, this is our current bond yield. Well, let me get into what this shape means if you don't already know. Let's take a trip back in time before the recession. Okay, so here we are in April 2003 at the bottom to start the next rally in the stock market, which will go on all the way through till 2008. So, look at the bond yield curve on the left. Do you see how the 3-month short-term bond yield is paying out less percentage than the long-term bond yields, which that's normal. I mean, from a risk-reward ratio, if you're getting your money back sooner, then you're taking on less risk in theory, and therefore you should get paid less versus if you're going to get your money back in 30 years, you should obviously get compensated for that, because who knows if we're all going to be here in 30 years. Just joking, but that's the way it works. So I'm going to go forward in time and watch the bond yield curve to your left and notice what starts to happen to it. So I'm 2004, 2005, and do you see that right there? Watch this. 2004, 2005. Okay, so it flattened out. That's basically what happened here. Short-term yields have become equal to long-term yields. It doesn't really make sense. So look at how this starts to flatten out, and interest rates rise as a whole, right, and it keep rising right before the crash happens. And then right as soon as it starts to crumble, the bond yield, the short-term bond yield starts to get lower, 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 and boom, and they go to zero. So, okay, how is this going to predict the future? Well, actually, this is happening right now. So let me go to the present day. Okay, bottom of the bull run. Here, we'll do the same thing over again. Start at the bottom of this bull run that we've been in the past 10 years. Crazy. Let's go forward in time. Pretty much stayed at zero. Short term stayed at zero. Stayed at zero. And now, finally, it's starting to rise just this past 2 years. Slowly starting to rise, and look at what's happening, and here we are. What's happening, guys? The bond yield curve looks like it's doing exactly what it did here when it started to do the same thing, flattened out. And then what happened after it flattened out? Boom. I don't want this to happen because this would hurt a lot of people if the stock market crashes again. I mean, a lot of people think it's going to crash. Okay, so how long did it stay flat until it crashed? So I did this before I made this video, and it was about 2 years. So, 2006 to 2008, it was essentially flat that whole time before it seriously crashed. So here we are right now, and it kind of looked the same in around 2006, 2005. So if history repeated itself, we might have another 2-3 years before, if it happened exactly the same way, which I'm not saying it is, but if it did, then that could be maybe a gauge, which on one hand is a good thing because it gives everybody time who sees and notices these things. It gives you time to get into what I'm going to talk about here in a minute, which is gold and silver, to buy some of that and maybe some other assets, but gold and silver, yeah. So let me pull up a gold and silver chart and try to kind of compare these two charts. So here's the gold chart priced in US dollars per ounce. It's going back from 1998. Okay, so if you look here at the crosshairs in November 2007, you can see right here. Let me try to indicate this a little bit if I can. So this time period, we'll go compare this to this chart here, 2007, September 2007. Okay, so September 2007 was when the stock market started to crumble. The bond yield was almost flat. And when that happened at the same time, this big green candle is what happened at that same time. Boom, spiked up. There was a little sort of consolidation there. And then right here, we'll go forward a little bit more when it really spikes up. Let's see the date on that. Let's move this over. So, okay. I was actually looking a little ahead here, but we'll go to, I don't know, let's go to March or April 2008, see what happens to gold. Probably it was going down because everything was going down. So yeah, in that time period, it starts to go down as everything was going down. The stock market was crashing, the whole financial system was collapsing, but this is what actually ended up happening. It had a small kind of correction there because everything was coming down. Like people just didn't know what to do, and that's what always happens in a meltdown. The markets, all markets go down. But then that money needs to find somewhere to go, and it obviously came into gold because look at when this bull market started, January 2009. Let's move this over. January 2009, at the lowest point of the stock market, gold started to rise. Now you can say, well, yeah, the stock market started to rise too, but if you were old enough to live through that, the stock market might have been higher a year later in 2010, but the economy was doing terrible. I mean, businesses were closing down. So many people were unemployed. So don't, try to... The stock market was going up, but people were recovering their losses. People were losing their homes left and right. I mean, it was not very fun. It was when I was in high school. I remember it. It wasn't very pleasant. So people were still scared. The economy, the stock market might have been recovering, but the economy sure wasn't. So when that happens, look at what happened to gold. That's when you heard years ago all those commercials, gold's as high as it's ever been and blah, blah, blah. You were getting like bombarded with gold advertisements because gold was just, on a bull run. So then it finally reached its peak here in September 2011. So that's when it kind of started to flutter out. And now the stock market, September 2011, well, the stock market basically has recovered its previous losses. People have forgotten all about the recession. Now we're back into basically uncharted territory because if you look right here around 2015, this area looks like it could have did this. It could have straight went down again, but it didn't. I don't know, maybe quantitative easing, the Federal Reserve, buying everything, buying bonds, buying corporate bonds, maybe even stocks, who knows, but it didn't crash, and now it's just basically going parabolic. Look at this, it's going straight up. At the same time, the bond yield is starting to flatten. Gold has been going down. Now, I think it's kind of it's kind of going sideways here because I believe that it's sort of baked in to the price of what I'm speaking about right now. This is not an unknown thing. There are, people who obviously know and have connected these dots. So I think that's kind of baked into the price a little bit, which is why gold is not just completely crashing or, way down here somewhere. But my point is, if in another couple years this bond yield curve actually flattens, interest rates rise, that'll put pressure on the stock market. If history repeats itself, this monster of a 10-year stock market bull run, if that crashes, it's going to lose a lot of value. It's going to affect the economy because everyone has a 401k. I mean, people just literally count on that. They think that they can put their life savings in the stock market, in their 401k, because they don't even understand what a 401k is. They just hear, it's good, you should do it, which there are, there are some benefits like the company match. That's 100% return immediately. But other than that, you can't take your money out unless you want to take the penalty. So it's pretty much designed to keep middle class people. I mean, just plain and simple. But I'm kind of getting off topic here. But anyway, I just want to wrap this up. Pretty much, you know what my point of this is. I'm buying silver. I'm buying gold. I'm not necessarily buying it to make money. I'm buying it to keep the money that I already have. I can tell you I'm definitely not putting my money in the stock market at these highs long term. I mean, guys, don't buy at the top of the market. I mean, even the housing market has recovered since the crash. And if you ask a real estate agent, is now a good time to buy? They're going to tell you, yeah, it's the best time ever. It's the best time to buy. But they always say that. I mean, come on. Don't just... It's silly. Don't buy at the top of any market. People in the crypto world pretty much know this. Any trader knows this, but the average person, they buy at the top and then they sell at the bottom because they need the cash. So, stay ahead of the curve. Try to take some of your profits, really. If you've been in the stock market the past 10 years, take some of those profits. If you can, take a small penalty and then put it in gold and silver. I'm not saying put everything, but just you got to have some gold and silver, because once again, when this recession happened, boom, crash. Look what happened to gold and silver, or gold. It went up. So you hedged yourself. You may not have made a bunch of money, but you definitely didn't lose money. And that's what you should really be focusing on when you invest your money. Not so much how much can I make, but how much can I not lose. So, with that said, I'm pretty bullish on gold and silver for, the next 2 to 3 years into the future. Could this whole thing happen sooner? Sure, but I know one thing, that it's not going to go on forever. Who knows the time? Maybe another 2-3 years if history repeats itself. But I'll let you guys decide that. All I know is I'm buying some more gold and silver like these that I got from Mint Builder. These are some numismatic coins here. Chinese panda, and what's this one? Australian koala. I have bullion too, but I just got these in the mail from Mint Builder. So if you want to learn more about that, links in the description. Okay, guys, I'm going to go ahead and wrap this video up, and I will see you in the next video. Bye.